Good morning, everybody. Thank you very much for joining this Goldman Sachs webinar on China macro and strategy. My name is Michael Snaith. I look after Asia Research Merchandising at Goldman in Hong Kong, and today I am delighted to be joined by my colleagues, Wei Shan, who's the Chief China Economist, Qinzhi Liao, who's the Chief China Portfolio Strategist. In the next sort of 25-35 minutes, we are going to talk through the readout from the CEWC meeting that came out last night. We're going to, as I say, talk through the takeaways. We'll talk through market implications. Please feel free to enter any questions you have into the Zoom Q&A box at the bottom of your screen, and we'll build them into the discussion as we go. Before we get going, I do need to read a quick disclaimer, please. This call is strictly for clients of Goldman Sachs only. It is not intended for media and is off the record. If you're not a client of Goldman Sachs or you've not received an invitation to join this call directly from Goldman Sachs, you should hang up now. Great. Let me hand over to Hui, but before I do, maybe if we start with the sort of December Politburo, and then if we sort of see what themes came out of that, and then into CWC, and then we'll pass over to Qinzhi. That'd be great. Thank you, Hui.
Sure. Thanks, Michael, and good morning, everyone, for dialing in. It started with the December Politburo meeting. That was the highest level of decision making in China. And the Politburo meeting was, in terms of the language, was a notable upside surprise, just given the fact that they used some of the words that they either didn't use before or used in a long time ago. For example, the phrase about unconventional countercyclical measures, or unconventional, above and beyond normal, extraordinary, depending on how you translate it, but you get the gist that this is a special situation, so we need to really step up countercyclical easing measures. That was not used before, so was a upside surprise. And another change at the Politburo meeting was the description on monetary policy. We know at this stage of the cycle we need more fiscal policy, but the description of China's monetary policy stance, changing that from a prudent, which has been used since 2011, to moderately loose, which was last used in 2009, 2010. You can imagine that give investors a lot of hope and potentially thinking about the easing, the massive easing during the GFC. So the Politburo meeting was a bigger change. On the back of the Politburo meeting, 3 days later, we had this Central Economic Work Conference. So compared to Politburo, the delta doesn't seem to be as big, because the Central Economic Conference pretty much just expanded a little bit on the Politburo meeting and didn't really introduce as big of a change in the language or in terms of raising expectations. So the overall takeaway from the Central Economic Work Conference is in line, given what we already know about the December Politburo meeting. But there are some interesting bits that we want to share with our audience. I think that if there's one takeaway from Central Economic Work Conference, if you just want to take away one thing, that's the emphasis on consumption. In the Central Economic Work Conference, if you pull out last year's readout versus this year's readout, the main body of the readout has the 9 points of focus areas or key messages. All the other things are pretty much similar, talking about reforms, opening up, urban-rural development, people's livelihood, and so on and so forth. Those are the order is the same, the language is slightly different, but this year they changed it to move consumption at the number 1. Last year was technology and innovation. That was the number 1, and this year is consumption and boosting domestic demand. So I think that's the most important change, and is a clear signal that they want to focus on consumption. Now we get a lot of questions, how do you focus on consumption? How is this time different? There are 2 differences. When I read 2023, the paragraph on domestic demand and consumption, it reads as if the government just want to create an environment where people want to consume, where this time around there's a clear emphasis on income. So I think that's improvement, because people need income to consume. You can't just boost consumption by having more, festivals or travel holidays. People have to have confidence and income to consume. So there's more emphasis on that. And the subtle difference is that last time when they talk about increasing income, they talk about middle class, where this time around the focus was more on low and mid income households. For example, increasing basic pension for retirees. For rural pension, the rural retirees, the pension, basic pension right now is very low. So there's definitely room to increase. In terms of specific areas, it confirmed our baseline expectation. Consumer goods trading program will be continued and broadened. There's a bit of a discussion about also increasing the support or subsidy for medical insurance. So overall, we think the consumption message, increasing income, increasing or improving the social safety net somewhat, is a positive signal. Let me lastly finish with a few sort of thinking about monetary policy, fiscal policy, property policy, compared to December Politburo meeting. Did we learn anything new, from policymakers? On monetary policy, the CEWC explicitly mentioned we need to triple our cut policy rate. So that's already in a lot of forecasters' baseline, including ours. We are expecting 40 basis points of interest rate cut next year. And there's also a phrase about creating new tools of a monetary policy. Not exactly sure what that means, but it's interesting, especially in light of what they talk about unconventional countercyclical measures. Fiscal policy compared 2023 CEWC versus the 2024 CEWC, a clear shift of more dovish. Because back then, it was, talking about proactive fiscal policy, but there's still a little bit of a remain disciplined and emphasizing sustainability. Where this time around, it's very clear, increasing deficit, more ultra long-term central government special bonds, increasing the different uses of a local government special bond. So it's a very clear signal fiscal will have to expand, and we're expecting about 3 trillion more of a government bond issuance in 2025 versus 2024. Property is a somewhat disappointing. We didn't hear anything new beyond stabilizing the property sector. The policies being mentioned continue that destocking process. We know that has been very slow and somewhat missing expectations after PBOC introduced that relending program to destock local excess properties. And there's a continued emphasis using urban village renovation. This was explained by the Ministry of Housing and Urban Rural Development in October. So nothing new. Doesn't seem to be a major policy in the property sector. They want to stabilize the property sector, but not sure how exactly. So those are the key takeaways from the CEWC. And I'll maybe hand it over to Kinger or back to Michael.
Thanks, Wei. Let's go across to Kinger for his latest thoughts on the market, and then we'll get to some Q&A. Kinger?
All right. Good morning, everyone. So from an equity market perspective, we think what we have got from the CEWC and Politburo readouts is a continuation or reconfirmation of the policy put and the pro-growth and pro-market narrative since September. But as Quay said, we haven't really received too much new or incremental information from the meetings that would change our base case on the equity market. And the story that we've been telling is that we certainly recognize the looming tariff risks and other domestic headwinds, but given the policy potential policy offsets that we can potentially get from the authorities, we believe that Chinese companies will be able to generate high single-digit earnings growth next year. Valuations currently at about 10.3 times forward earnings, and our fair PE multiple for MSCI is 11 times, so there could be some moderate valuation upside from here. And that combination would get us to around 12 to 13% potential returns for 2025. Now, within the equity market, the onshore Asia market has performed relatively better than offshore equities since the policy pivot in September. Now, one key reason for that, we reckon, is the perception gaps between overseas and onshore investors on policy easing. And this is very much consistent with our recent marketing feedback, which suggests that overseas investors are still very much embracing a show me the money mentality, i.e., I think most investors will need to see the details, the actual numbers of the fiscal stimulus package before they would turn more positive or re-engage in a more meaningful way. But onshore investors, on the other hand, they are more focused on the policy direction as opposed to near-term quantification of the policy. So that divergence suggests to us that the liquidity and sentiment backdrop will continue to be more supportive for the Asian market. So hence we maintain our tactical bias of A over H. And one thing that we feel a bit more confident after the two meetings in December is our sector tilt towards consumption, given this is an area where policy easing delta could be more visible and more forceful. As such, we stay overweight China, internet, and consumer tech in our sector allocation. We also upgraded healthcare just very recently to capitalize on the potential improvements in government spending, local government spending in 2025, helped by the debt swap program. Now, I think that might be a good segue to the themes that we like for 2025. Besides the shareholder returns story that we've been emphasizing for quite some time, we think one theme that is underappreciated by investors is the debt swap program and its potential impacts on local governments' spending capacity going into next year. Now, the logic here is that we believe that the financial positions and the liquidity circulation for local governments could improve quite meaningfully in the new year, mainly because of the incremental support provided by the central government. And in number terms, Hui and team are looking for 5% consumption growth for local governments for 2025, up from 1% this year. So against that backdrop, we believe that companies or sectors that are more exposed to local government's revenues and spending could benefit. So we've put together a list of stocks that we think could be good candidates to play the theme, and happy to share the details if there's any interest. With that, let me pause there and turn it back to you, Michael.
Yeah, great. Thanks, Kinja. Just to remind the audience to enter any questions you have into the Zoom Q&A box, and we'll get them to the speakers now. Wait, maybe I start with you, and let's start with the fiscal side. As you said, you're expecting another 3 trillion incremental in 2025. Maybe we can put those numbers into context, right? So it was 9 trillion this year. You think it's going to be 12 next year, which is getting close to where it's like 9% of GDP, roughly. And so these are big numbers. So I'm surprised that the market is not taking that more positively. Maybe you want to talk through how you think that will be spent, or where you think the questions that you're at least getting in terms of fiscal firepower, how it's raised, what that means in terms of expenditure in 2025.
Sure. Yeah. So it is when it comes to China stimulus, there are a lot of numbers being thrown around, and clients will ask me, oh, there's rumor about 10 trillion or 10 trillion stimulus or 10% GDP. We have to be very clear about what we are talking about. Otherwise, you're comparing apples to oranges. So first of all, the level of government bond issuance is already very high, right? This year, despite the very weak domestic demand, if you look at how much government issued bond, 9 trillion, that's not small. So the level is high, but when we are talking about economic growth, you only focus on delta. Right? Even if next year you have another 9 trillion, you say, oh, the 9 trillion, that's a lot, but there's no increase, so that doesn't help your GDP growth. So what we really care about is that 3 trillion delta. the 3 trillion delta is about 2.5% of GDP, and it's a sizable. Where does it going to help in the economy? Some of that will be used to recapitalize large banks. Some of that will be used for local government to buy back raw land and empty apartments, things like that. And some of that will be used for subsidy for consumer goods trade-in program and the strategically important major projects in major areas. So there's a wide range of areas that the government will want to use the money to help the economy, because we have the real economy slowing, which in turn put pressure on the financial system. You need to help all of these different areas. So what, as an investor, what you really want to focus on is that delta. That's something I want to emphasize. As an investor, when you hear, 5 trillion, 10 trillion, first of all, you need to know, is that the level? Is that the change? And then you need to know, are we just talking about the overall augmented fiscal deficit, or are we talking about the top line fiscal deficit? So there's a lot of sort of nuances and careful calibration necessary to figure out how is that going to impact the economy. All in all, the economy needs a lot of help. Private sector is weak. We need a central government to step in.
Thank you, Wei. And just continuing on that a little bit, in the last few days, we've seen, China 10-year yields essentially trade lower pretty quickly. And I guess that, there's one train of thought that says if the market thought the government was being able to reflate the economy in 2025, that yield should move higher. As you talked about, there's potential for, new monetary policy tools, and there's some speculation around whether that involves some form of bond buying by the government. So how do you, think about that move in 10-year in China in recent days, what that's signaling, and the sort of questions and debates that you're getting?
Right. So the recent decline in Chinese 10-year central government bond, it was faster than we had thought. We thought that the direction makes sense, that we need more easing, especially monetary policy easing, so therefore rates are on a downward trend, but the speed of a decline was a surprise. And in retrospect, that was linked to the December Politburo meeting you were asking about earlier, because of the change in monetary policy stance was more than market was expecting, right? If you're really going to change the stance to the 2009-2010 level, and then you look at the playbook in 2008-2009 global financial crisis, what did monetary policy do back then? It was a very aggressive cutting. So therefore, market all of a sudden was trying to price in a much more aggressive monetary policy easing, hence you see these rates coming down significantly. And the second point about reflation, if market believes that cutting rates will help speed up the reflation process, perhaps the 10-year rates shouldn't come down so much. However, I think the view is that monetary policy will only be able to do limited amount in helping the whole reflation process. If you think about the CEWC talk about we need to control the excessive competition in various industries. So that doesn't really respond to monetary policy easing as much. So if you think about these two are separate, reflation is going to be much harder because you need to control local government incentives and corporate decision, capex and competition. That's going to take a lot longer. Whereas if we are using monetary policy 2008, 2009 as a playbook, then the rate cut will be coming in much faster. The balancing the two, you get 10-year yield down below 1.9 now.
Understood. Thank you, Wei. And then just last on the top down side, on the macro side, if we think about that support for consumption, you talked about some, trade-in programs potentially being extended, maybe both the scale and the scope goes up. What else do you think happens potentially around that consumption support? And then we can get into some of the market implications for Kinja.
Yeah, on consumption, in a way, there's really no sort of a very easy solution, right? You can't force people to consume. So all you can do is to incentivize them. Hence the consumer goods trade-in program, and that has been relatively successful. And the second bucket is the sort of increasing employment, increasing income, and therefore stabilizing stock market, stabilizing property market to help boost the confidence. So if you have jobs and income on the one hand and the confidence on the other hand, then you have a better chance of boosting consumption. I think that's the way the government is thinking about. I thought it was interesting. They talk about increasing income of a low to middle income households, increasing, even the social safety net on the medical support. That's going to help you sort of reduce your incentive to save for medical emergencies as an indirect way to support consumption. They also talk about for flexible workers, the DD drivers, or all these people. China has a large flexible worker group, and they talk about increase their labor protection. So in a way, if you increase their income, and that's a sizable share of the labor force, that can also help their income, help their consumption. So I think of it as the auto subsidy, the home appliance subsidy, broadening that's more direct, almost a sugar high. You give the subsidy, people buy, consumption comes up. But at the same time, you also need to do the hard work, helping the stock market, helping the property market, helping the labor market, helping the income prospect, helping something that's more sustainable. Every month you give people money, not just the 1 month to give them a consumption coupon, and the next month there's no consumption anymore. You need something that help their expectation. I get this extra money month after month, and therefore I can be reassured it's okay to increase my consumption.
Great, thank you, Wayne. I think let's bring Kinja back into the conversation. I think we can all agree from a market perspective that risk reward is increasingly interesting and attractive in China, even if the sort of fundamental momentum continues to be a bit bumpy. If you take a step back and you talked about maybe investors needing some specifics, is there a part of policy that they need to see more details on? We've seen reliquefaction of local governments, we're seeing consumption support, we're seeing fiscal stimulus. Is it bank recapitalizations, and that is going to be the trigger for investors to start reallocating money back into China?
Yeah, I think this is one of the necessary conditions that we need to get, so that especially overseas investors to re-engage China in a more meaningful way. Now, as Kui said, the fiscal policy is important, but there's a lot of moving parts in the fiscal side of things. So I think based on my conversations with investors in the past few weeks, I think most of them definitely would be very focused on the 2 sessions in March, so that's the venue for investors to get more clarity about the fiscal policies next year, how much money will be spent in different areas. But clearly the focus is on consumption-related measures, right? I think this is the most important thing and most topical kind of subject that everyone is very focused on. Now, just on the consumption story, I think Kui mentioned that the trade-in program, I think incrementally that's definitely helpful, especially when you think about the multiplier effects here. So, I mean, based on officials' estimates, you talk about 4 times to 5 times multiplier effect of the trade-in program, because you get 10, 15%, 20% discount, right, using vouchers or consumption coupon, whatever. But on top of that, I think one thing that is underappreciated or overlooked by investors is that in China, local governments are one of the largest consumers, right? So consumption represents about 55% of GDP, and 1/3 of the 55% comes from local governments. So to stimulate consumption from a more broader perspective, I think getting local governments back in shape in terms of their financial positions and the liquidity circulation is quite critical. That's why, as I mentioned earlier, we like certain private household consumption related areas, but at the same time, our strategy is very focused on finding the delta in the consumer space. And I think one of the biggest deltas that we can get in 2025 is local government consumption.
Understood. Thank you, Kinju. And if investors do come back to China, do you get a sense in terms of like where the pecking order sits? Are we going to, see a lot of focus on consumer first before we go down some of the other sectors? Like, where do you think China clients come back to first if they want to express a more positive view on China?
Well, first of all, again, the Asian market has already performed quite well in the past few months. I think it goes back to my comments earlier about the divergence in terms of perception gaps on policy easing between overseas and domestic Chinese investors. So let's say if international investors are turning a little bit more positive, a little bit more hopeful on policy easing, obviously the Hong Kong market, the overseas market, the offshore markets would do better. And within sectors, I still believe that sort of the internet, China internet, would be the first one that they look at, given the liquidity, size of the sector, and most investors are pretty familiar with the fundamentals of China internet. So number one, China internet. Besides that, I think consumer-related proxies for sure, given this is the area where the policy easing could be more forceful and more meaningful.
Understood. Thank you, Kinju. I think that is a good place to pause. Thank you very much to the audience for your attendance this morning. Thank you very much to Team Goldman for your comments this morning. Wishing everyone a great, rest of weekend ahead when you get there. Thank you very much.